Hey, it's Rob Weinberg, and on this channel we empower people to take control of their futures through expert mortgage, financial, and real estate strategies. If it's your first time here, go ahead, hit that subscribe button, and don't forget to get notified on all of our future content. In today's whiteboard lesson, we're going to be talking about no income and limited income verification mortgages. And this is a really opportune topic right now because there's a lot of people out there that aren't able to fully document their income and they're not able to qualify for traditional mortgages. So there has been innovation in the industry and there have been a lot of new loan products come out over the last 6 to 12 months that bridge that gap. Now, these no income and limited income verification loans are mainly used by entrepreneurs, self-employed individuals, and real estate investors. And the reason why those individuals use these products is because as an entrepreneur or self-employed individual or investor, you're not showing all of your full profit on your tax returns. The way that business accounting works nowadays, unfortunately, the way the IRS tax code works, the information on the tax returns doesn't always represent the full true profit of the business, and a lot of those people are left out and unable to get mortgages. So again, the gap has been filled. The first loan product we're going to talk about is no income verification loans. With these loans, there's absolutely no income verification at all. It's left blank on the loan application. So these are great for people that might have just started a business recently, so they don't have the criteria to actually qualify for a conventional loan where you generally need at least like a year or two in business, generally 2 or more. This is great for that scenario, or someone that just has really irregular or weird income that you can't document it at all. These no income verification loans are perfect. One of the reasons that they're great is because they allow you to use them on a primary home or a second home or investment property. Some of the other products we'll talk about, they only allow you to use it on an investment property, but the no income verification loan allows you to use it on a primary home as well. Let's jump into the criteria to qualify for this loan. So generally 640 to 660 absolute minimum score, the higher the better. And you're gonna need a minimum of 9 to 12 months of reserves after closing. What are reserves? So reserves are gonna be the multiplied factor of the mortgage payment. So if you need 9 months of reserves, they take the total mortgage payment on the new property, principal, interest, property taxes, and insurance, and multiply that by the reserve requirement, in this case between 9 and 12 months. So after accounting for down payment and closing, you need to have that money left over after closing. 20% down is the absolute minimum with the no income verification loans. So you're not gonna get into these first time buyer programs or 3 or 5% down. It's 20% or more. Most of my buyers with this use at least 20 to 30% down, or closer to 30, I should say, to get the best interest rate, the best terms on these no income verification loans. Now, the next loan type that I wanna talk about is a DSCR loan, or debt service coverage ratio loan. Now, a DSCR loan is the rage with the investor community, and these DSCR loans are only used by investors. They're used for investment property only. You cannot use these on a primary home or a second home. Nobody, including yourself or your family, can live in the home. You're gonna sign an affidavit at closing stating that. So DSCR is great because it's looking at rental income on the property versus the new mortgage payment. So for example, if you have a $3,000 a month mortgage payment with tax, insurance, everything included, meets or exceeds, the lender generally wants to see that the rental income, that mortgage payment. Now, there are plenty of DSCR options if the loan does actually exceed the rental income, meaning if the rental income will not cover the mortgage payment, there are still DSCR options available. It's just not ideal. In order to get the best terms on a DSCR loan, you're gonna wanna have a DSCR of it, ideally maybe 1.25 or even 1.5 or more. This criteria is where lenders will give you a break on the interest rate or better terms on the loan the more the rental income exceeds the mortgage payment. So if you're dealing with a property where the rental income does not exceed the mortgage payment, just make sure you've got a lender that you're working with that has that ability to lend lower than the 1 DSCR. There are only certain banks that will do that. So that's the DSCR program for real estate investors. Next one we're going to cover here is the P&L program. This is also known as profit and loss. So the P&L program is great for business owners that have been in business at least 2 years, but just have a problem documenting that tax return income. So with the P&L program, we're gonna have your CPA go and do a 12-month profit and loss on your business. It doesn't need to be complicated. It doesn't need to be audited. It just needs to be put together generally by a CPA, and it'll simply state your gross profit, gross income, and then it'll have a breakdown of your expenses, and then it will reduce your gross profit by those expenses to create your net profit. Okay, that net profit is what can be used by underwriters to qualify you for the mortgage. So this can be, again, great if you have had maybe certain write-offs or your tax return didn't turn out the way that it hopefully could have to get you approved for the mortgage. The P&L is a great workaround that we can use to get you in. Now, P&L loans, you're talking about 660 to 680 credit scores generally I see with these minimum, and you're also gonna wanna have a minimum of 15 to 20% down for the P&L program. There's very few options less than that. So P&L, again, another great one there. The next limited doc loan we're gonna discuss is the 1099 only program. So with 1099 only, the underwriter is simply gonna get a copy of your latest 1099 form, then they're gonna apply an expense ratio to that 1099, generally around 10 or 15%, and then whatever the outcome of that formula is, that's what they're gonna let you use for your qualifying income on the mortgage. Or again, the tax return just didn't have the right information to get them approved for a conventional loan. So 1099 only is great, and I've even heard of some banks offering this with only 1 year of 1099. So you don't need to have necessarily a 2-year history. If you've been employed in that same field previously, that can be a great option too. The next program we're gonna talk about is the bank statement loan. Now, the bank statement loan has been super popular lately because with this loan, you can look at your last 12 months of personal or business bank statements, apply an expense ratio to that, and then the resulting equation ends up being what we use for your qualifying income. Be great for a lot of business owners that have a ton of money coming into their business, but maybe they don't take a big salary, they don't take a lot of distributions, they don't show a lot of income, again, on their taxable. So I've been using the bank statement loans a lot for people that are looking to consolidate debt and refinance. I've also been using them for home equity loans or home equity lines of credit. There's several banks that will allow a bank statement program put in the place of that full documentation. So we can still get you a home equity line of credit, home equity loan, or a second position mortgage using those bank statements. So as long as you have personal or business bank accounts that can show consistent deposits for 12 months, that's the way we're gonna do it. That's the way you wanna go. So we'll look at the total 12 months and then divide that or average that out for your qualifying monthly income. So let's talk about documentation requirements for all these programs. On the P&L, you're gonna need that CPA provided P&L. Also, you're gonna wanna have reserves. For pretty much all these loan programs, they're gonna require some sort of reserve. That's money that you're gonna have in the bank after closing. So if you're putting 20, 25% down, you're gonna wanna make sure you also have prepared ahead to have that reserve for after closing so that your loan will get approved. Get these loans through. Who offers these mortgages? A lot of the time you'll find if you talk to a bank or a mortgage servicing company about these, they don't know anything about it, they don't offer them. What you're gonna need to do in these scenarios is you're gonna need to talk to an independent mortgage broker. You're gonna need to speak with someone that has a breadth of different loan options. Like myself, we have over 130 banks offered through my current platform, and it's important to deal with someone that has a lot of different banks because limited doc loans, no doc loans, these are only offered by a very, very small segment of the banks out there. So you need to make sure you've got a broker or someone that knows how to navigate this for you. There's no way you're gonna find it just cold calling or going out on your own. Work with a broker that knows the market, that can bring you out in your scenario into the market and figure out which one of these loan products is gonna work the best for you to what you're looking to accomplish in your specific situation. So I hope today's whiteboard lesson has given you some great information on no doc and limited doc mortgages. I hope that I've motivated you to get out there, get into the market, and make your real estate dreams a reality using these programs. Do offer one-on-one personalized consultation, so if I can be of assistance to you or someone that you know, reach out to me by call, text, or private message. My direct line is 860-413-3938. As always, I hope that helps, and we'll see you on the next episode. Take care.